Welcome to CSI Chat, where every topic's fair game. From finance to mysteries, we'll never be the same. Our hosts an accountant with a knack for a joke. We'll dive into the details and laugh until we choke. CSI Chat, where the numbers beat the fun. We'll explore every subject under the sun.
Okay, well, we are very lucky today to be joined by Kjetil Nyland. We are here to talk about the book. And again, to give you a little bit of background on the book, it is called The Compounders: From Small Acquisitions to Giant Shareholder Returns. And it's a book which highlights a select group of high-performing conglomerates led by exceptional capital allocators and who use a decentralized structure and operate in fragmented markets and really redefine acquisitive growth. It is a fantastic book. I would highly encourage everyone to take a read of the book. You might not be all that familiar with it, because it features several companies that are based in Europe, and more specifically based in the Nordics or in Sweden. But again, I would highly encourage everybody to take a read of the book. It is a terrific book. The book was written by three individuals, and we are really lucky today to have one of the co-authors join us. So we are joined by Kjetil Nyland. Give you a little bit of background on Kjetil. He has over 15 years of experience in the financial industry and is currently an equity portfolio manager at REQ and co-manages the REQ Global Compounders Fund, properly named, I guess. Well, Kjetil, thank you very much for joining us today. We very much appreciate you taking the time.
Thank you, Scott, and thank you very much for those kind words about the book. Looking forward to chat about it today.
Yeah, if you have an interest in investing, and again, a lot of the people who are listening I would highly encourage you to take a read of the book. But maybe just give us a little bit of background. Maybe just give a little bit of background on yourself, Kjetil. How did you get involved with investing? Give us a little bit of background on how you got down the investing rabbit hole.
Right. Yeah. So I guess for me, it wasn't one of those started buying stocks when I was 10 years old type of stories that you sometimes hear, right? For me,
Yep.
It started much later. So I think it was around 2007. So I was majoring in finance at the time. And I stumbled across Warren Buffett's speech on YouTube, actually. And something just clicked because up until then, I think, for me, the stock market always had this like casino vibe, right?
Yeah.
And I guess it obviously behaves like a casino.
Absolutely.
Still, right? But
Absolutely.
and there was something in that speech. Buffett talked about, even though you're dealing in public equity, where you should have basically the same mindset as you should have towards a private business, right? So if you had this private business mindset, even though, the price is jumping all around, you could pretty much ignore the volatility, right? So I think that was like epiphany for me, that you could, you have this sticker and this price jumping around all day, right? But as long as you have that private business owner mindset, you could essentially ignore it. So it was a shift from speculation to more of an ownership mindset, I guess. And so later, in 2010, I got my first job in a software company, actually, serving.
Oh, really?
Yeah. So that was Scala Financials, it's called. We were serving asset managers and financial institutions in Norway primarily.
Like in the finance group, Kjetil? Like as a finance person?
No, I had different, I guess, entrepreneurial role in that company. So I was everything.
Oh, cool.
So it was a small company, and speaking, I actually think we had a company under the Constellation brand reaching out at one point. So.
Oh, really?
Yeah. So that's interesting.
Small world.
Yeah, I didn't mention that, but that company got sold eventually, and so later I actually had while I was working there, I was obviously very interested in the stock market and investing. I was actually writing an investment blog. I was quite early in that domain, so I had still a passion for investing. And in 2015, I had a choice had a chance to join a long, short global fund here in Bergen, Norway. And I eventually got more and more responsibility. So that was super interesting. And then fast forward 7 years in 2022, 2022. That was when it really clicked, when I had opportunity to join RAQ, my current employer. So
Got it.
so basically we are a boutique asset manager in Norway and Sweden, when we are a team of 5 people on the investment side, 3 PMs and 2 analysts, managing 2 long-only funds, only focusing on the companies that we wrote about in the book, actually. So yeah, that's my short little bio for you.
Got it. And would you classify yourself, Kjetil, as a value investor? Is that kind of how you think of yourself?
Yeah, I mean, I grew up, reading everything about value investing, obviously, but I think the honest answer, yes, but probably not in the traditional sense. So, when I first got into investing, value investing for me at least meant, something very static, right? I mean, you're basically looking at a snapshot where you're buying into the present, not so much relying on the future, perhaps, and that's where you got your margin of safety from, right? So I think that ended up, you often end up in, looking at very cheap multiples. And I think I dabbled around in that world for quite some time. But I mean, value obviously is the present value of future cash flows, right? And I think that those future cash flows obviously depend heavily on the reinvestment rate, the return on capital, the duration of that equation, right? And I guess we will talk a lot about that later, but I think it's just like interesting to think about the fact that 2 identical companies basically have the same earnings, same margins, same multiple today. But if that one of those companies can reinvest at high returns for a very long time, then obviously the outcomes will be completely different. And the multiple, the identical multiple just don't give justice to that fact, right? So, I mean, you could still get your re-rating or whatever, or what have you, but I think in the other example, you're just relying much more on the business compounding, right? On what the business can generate, so to speak. So, but I mean, still, we care deeply about price, but we primarily focus on business that can generate very strong cash flow. We invest a lot of that cash flow back into primarily acquisitions, and can sustain that reinvestment for a very long time. So obviously we pay a lot of attention to management quality and capital allocation discipline, because that determines obviously the company trajectory. So yeah.
And give us some background on the book, and maybe just roll the clock back. I don't know how many years prior to the release of the book you and your co-authors had come up with the idea.
Right.
But give us just a little bit of background, a little bit of insight on the idea of the book. Like, was it just kind of a light bulb that went off and said, "Man, we got to write a book about this"? Give us some background on kind of how the book came to fruition.
Right. I mean, the project, I guess, started for I would say 3 years ago. And I mean, the idea for the book really came out of the strategy we were already running in RAQ, right? So we have owned many of the companies in the book since they became public in prior roles. So I think that, I mean, first when we started writing the book, it started more of a case study where we were, I mean, it was more dry, right? I mean, it was like almost like a write-up of the 9 companies that we profile in the book. And then we just eventually figure out that, okay, this really has to be engaging for the reader to actually take the time to read this book. So then you want to have some storytelling around the companies, finding good introduction which really hook the readers and so on and so forth, right? So, but I mean, in terms of like the real idea also, I mean, if you just look at the returns across, I mean, there are 9 companies in the book, right? 5 Swedish one and 4 international ones, and it's just they have given some amazing returns, but no one really has told the stories in any cohesive way. That's really the reason, right? And just to give you some quick facts before we dive in more here, if you just look at the 9 companies in the book, they have on average, they have been listed for 27 years. During that time,
Yeah.
they generated a 25% CAGR during that time. So that is almost a little bit over 400x actually. So yeah, the returns really speaks to themselves, right? So yeah.
And when you were looking at these, were you surprised that, I don't know if it started with looking at companies that generated the highest return, but were you surprised then when you started looking at these that many of them had some of the same characteristics, like whether it's decentralization, the ability to, reinvest cash flows at a high rate of return? Was there again another light bulb went off and say, man, like when you take these nine, there's a ton of similarities that kind of spread across across each of these companies. Like, were you surprised there was such a commonality across these?
Right. I think that was also part of the reason, man. We know these companies quite well. And as a stand, we have actually been invested in many of these companies since their IPO and prior roles. So we knew they had some strong commonalities. And that was really like the common denominator that we wanted to, dive into and try to communicate as good as we can in the book itself, right? Because we conclude basically that, there are two recurring themes in the book across the nine companies, and that is, a very strong, high-performing, decentralized cultures running through all nine companies, and then secondly, they have this, extremely strong reinvestment engine, where they can sustain that reinvestment ratio for a very long time, leading to these, fantastic returns that we talked about earlier. So, yeah.
Was it hard to whittle it down to nine? Shadow, was there kind of a 20 that you had to bring down to nine, or was it really, it was these nine from the get go?
Right. If you look at the universe of these type of companies, it's a limited universe, that's for sure. And if you just think about acquisition-driven compounders in general, there are a lot of companies out there, but there are not that many companies who are ticking all the boxes, so to speak. But there were more than the nine we chose, that's for sure.
So maybe, the book is called The Compounders. So it's an interesting title.
Right.
Maybe just talk a little bit about how do you define a compounder? You talked about, you just mentioned kind of the two main themes: decentralized structure, ability to reinvest cash flows at a high rate of return. How do you define a compounder that's going to make it into the book and makes it into one of these nine?
Right. I think perhaps it's just interesting to start out with, what do we mean by, compounding, right? If you just think about fundamental compounding, right, it's just really the reinvestment of cash flows. That was simple, right? So, earnings growth takes capital. If Nike wants to sell more shoes, it needs to build more factories, it needs to build more inventories, it needs to be more marketing, right? So growth takes capital. So in the book, we actually lay out the three ingredients for fundamental compounding, which is obviously a reinvestment rate, return on that reinvestment capital, and the time or durability, right? And I think it's just so interesting to think about the fact that, as humans, we are not wired to think about compounding in the right way, right? Because exponential growth is not very intuitive for us humans, right? So I think that's interesting. And secondly, I think it's just something that we didn't talk about in the book. But if you think about equities, right, versus, for example, bonds or real estate, right? The real magic of equities as an asset class is really the ability to retain part of its earnings every year and reinvest it for the investor. That's that's a unique trait about equities as an asset class. I think we in the book we make a point about if compounding had a sibling, it would probably be called an acquisition-driven compounder. And what do we mean by that, right? I think when you think about a great business, a lot of people talk about, a business that have a return on capital, for example, of 20-25%, right? And that may look fantastic, but the real question obviously is how much capital can be reinvested in that 20 to 25% return on capital, right? And I think a lot of companies, especially if they just would have one engine, so to speak, if they just grow by organic growth, for example, right? I mean, let's think about the Walmart, right, in the early 70s when they, expanded or scaled their box concept throughout North America, right? Primarily growing organically. I mean, that's fantastic, but you don't often come across those type of situations. So I think that you just having two engines for growth. I mean, organic growth, but also acquisitions, just extend that duration of compounding, which is quite unique for the nine companies in the book actually, and it's the number one reason for why they have delivered the returns and deliver basically.
So I'm going to play devil's advocate here for a sec, Kjetil, because it wasn't that long ago we posted an episode with a couple of professors who wrote a book and have strong evidence that would show that 70% of all acquisitions end in failure. They don't end all that well. Now that means that there's another 30% of the population out there as well. But what if I came to you and said, you know what, everything you're saying makes total sense. If you can find a company that can grow through acquisitions and continue to maintain those high rates of returns, that would be amazing. But when you look at the data, 70% of acquisitions actually end in failure. How do you reconcile those two? How is there some companies out there or some entities out there who are able to kind of overcome the data and really, turn that acquisitive growth into something that's really, really positive for shareholders?
Right. I mean, first of all, I think that, that big misconception perhaps is that all M&A gets lumped into one bucket essentially, right?
Yep.
That's just not true. And I think that, that statistics mostly refer to, large headline grabbing deals, public to public mergers, transformational integrations, big synergy promises and heavily leveraged, all that stuff, right? So I think that statistic primarily refer to a very specific type of M&A. And yes, that often fails, I think. So, I mean, if you look at the 9 companies in the book, right? I mean, the acquisition-driven compounders we profile, I think there is a recurring theme of small, repeatable acquisitions. They're also private, often family-owned companies. And they're primarily bought off market, actually. And they usually constitute less than 1% of group sales. So very small. And no heavy integration, no big turnaround. So I just think it's closer to a process than a one-time event, basically. So, and I think those type of companies are not represented well in the usual M&A statistics and the base rates we usually read about. Right?
Yeah, well, you're bang on. I think these large acquisitions, the headline acquisitions that end up on the front page of the newspaper, probably even as well, like just when you roll up the data, those numbers are going to be the largest amounts of the population, just because some of these acquisitions are massive, right? In terms of in terms of the size, and these little acquisitions that fly under the radar, they don't get captured. Like, it's stunning to me that there's more people out there that don't realize, again, the power of that acquisition engine and the power of these smaller acquisitions and how they can be so accretive to shareholder value.
Right. Yeah, no, spot on.
So then, the other thing about your book, Kjetil, is obviously the focus on Sweden, and you have some discussion in there about about Sweden itself. Is there something in the water in Sweden? Now, again, not all the companies are based in Sweden, but there's several of the companies that are based in Sweden. Why do you think there's such a strong Swedish element to all this? Now, I know, again, you guys are all based obviously in the Nordics, so that's your home. You're going to be most aware, most familiar with the companies that are closest to home. But why do you think, what makes Sweden different, especially when you kind of cross compare it to some of the other countries that maybe don't have the same, proportion of compounders that exist within their stratosphere?
Right. I mean, I think there are a couple of aspects around Sweden which is very interesting. We actually call it the Silicon Valley, Silicon Valley for these type of companies in Sweden, right? So I think that just a second. We've had a problem with my sorry. So when you look at the history, right, it actually makes a lot of sense because I think a few structural things came together at the right time. So first of all, Sweden is a small export-driven industrial country. So we have a very, very small domestic market. So companies had to actually think globally quite early.
I see.
And
Yep.
that created a lot of, small niche B2B specialists actually. So importers and distribution companies. And in the early 1960s, actually, many family-owned SMEs were also coming up for sale. So founders were retiring and they had succession issues. So you had a deep pool of acquisition targets. And then I think also, I mean, so that was, the structure of it, the deal aspect of it. But if you look at the legacy of decentralization in Sweden, we have two important figures that, in 1967, for example, we had a guy, Hans Werthén, who became CEO of Electrolux. And what he did was quite unusual at the time because he pushed decision-making down to the operating units. And he had also, famously, one of the first things he did was actually just sell the prestigious headquarters building in central Stockholm and move it to the city's outskirts. So that was quite headline grabbing at the time, actually. And during his tenure, Electrolux completed actually around 200 acquisitions without building bureaucracy. And then the second important figure is Jan Wallander in 1970, who became CEO of Handelsbanken. I mean, that were one of the biggest banks in the Nordics. So basically what he did was to, scrap centralized budgets and cut the head of his staff. And he gave local branches full lending authority. And surprisingly, that actually led to, one of the lowest credit losses in Europe. So that was quite an unusual move. Move there. So the common denominator of these two people is, trust the people closest to the customer. That was basically the lesson. So and these two CEOs really inspired actually the next generation of compounders. Carl Burnett, for example, who grew inside Electrolux culture, applied the same structure in Lifco, which is profiled in the book, and also influenced Anders Börjesson of Bergman and Debing, who we profile, and who spun off two companies in the book, Lagercrantz and Antec, but also Indutrade, where, Industrivan, where Jan Wallander was actually on the board, and they controlled Indutrade for, I think it was 16 years or so. So long story short, but what I'm trying to say here is that there is a deep heritage here and a decent setup for these type of companies in Sweden. So that's basically the reason.
Yeah, we need to talk a little bit about the leadership as
Right.
you've mentioned, Kjetil, because these are interesting leaders who kind of go perhaps go in a different in a different direction than how the status quo, at least before them. But if you were to characterize, looking at the companies in the book, and you were to say, look, is there a common thread that exists amongst those leaders? Is there a common thread that exists amongst each one of those 9 leaders that you would say would apply to each one of those folks in the book?
Right. I think I guess it depends a little bit if you're talking about the HQ, right? I mean, the management at HQ or the leaders in the subsidiaries. But I think you see a lot of common traits. I mean, at the top, I think there are mostly, I would call them culture guardians, right? So they are not like charismatic empire builders that you read about in the newspaper.
Yeah.
So not a flashy CEOs or anything like that. So long-term thinkers, I would say. And I think perhaps more importantly, they're given permission from the board to actually think long-term. I think that is perhaps an aspect we didn't write that much about in the book, but I think that is actually quite an important attribute around this, that they have, permission from the board, because obviously you have long-term owners in these companies, which provide that permission. But I think that, they tend to have quite low ego. They focus on cash flow. They think like investors, and they have very strong capital allocation skills. So I think that would.
So So I'm gonna simplify this, because you mentioned a lot of things, low ego. You mentioned the story of them moving headquarters out
Right.
into Timbuktu, to, probably to save rent and everything like that. But I'm gonna simplify this down because your book, has got tons of amazing stories as part of it. And we're gonna try and highlight some of these stories during our conversation. We've only got a limited amount of time, but one of them is and I don't know, again, you've probably met with everybody, all of the leaders, but Cheryl, take us through the process when you actually go and like knock on the door to meet with these folks. Because again, some people might be thinking, man, these are like multi-billion organizations. You've got to go through, six admin assistants before you're going to reach them. You get there and like, you're having dinner served by chefs and things like that. Like there's kind of a vision of maybe, in these super fancy headquarters where it's like these ivory towers and things like that. But I think it's actually closer to the opposite. And maybe,
Right.
Shuttle, I don't know if you have a good example, but take us through meeting one of these folks, like where, again, you're making the or the CEO's making the coffee for you. You
Right.
know what I mean? Like it's almost like the complete opposite to what people might expect of these multi-billion-dollar companies.
Yeah. Yeah. I mean, it's spot on. I mean, we were surprised multiple times actually. But, sometimes when we met at HQ, the CEO came himself or herself making us coffee. And I think it's just that, I mean, if you think about the 9 companies in the book, the common denominator is that they are extremely decentralized. And that shows up physically. And what do I mean by that? Well, it's extremely lean HQs. I mean, they don't have obviously a lot of middle management. There are not a lot of shared resources. So it's very compact HQs where just a couple of people, primarily responsible for capital allocation and, structuring the right incentives and so on and so forth. But so a couple of stories. I mean, first of all, Judge of Scientific. I mean, there was one we're going to visit them. We arrived in London, and we basically thought we had the wrong address because there was like no time, no reception, just an old apartment building, right? So we walk in, small office. I think there were maybe 4 desks, and David Cicurel himself, the CEO, was meeting us, making the coffee himself. So no layers, no corporate theater, so to speak, right? So that was quite unusual. And second, I mean, Lifco, another company in the book. So just for context, I mean, they have around 250 subsidiaries, 6,000 employees, market cap of around 40 billion US, 600 million in EBITDA. And when we visited the HQ, Per Valdemarson, the CEO, he made coffee himself and no secretary. Sometimes he was actually alone in office. So yeah, quite unusual compared to, I guess, many of the bigger corporation in North America, for example.
Why do you think more companies don't adopt? Like, I love those. Like, I just think that's great. Those stories. And then you probably drive downtown Stockholm and you look at all the buildings and these fancy offices and things like that. Why do you think more companies don't adopt kind of a similar approach towards like frugality and really saving every dollar? Like, do you think it's maybe easier for a smaller company to do it, and then as they grow and grow and grow, that the pressure to expand and jump into that next wave, there's only a few people who can really withstand that pressure to some degree, right? And like, just your thoughts on it. I'm
Right.
just surprised more companies don't kind of adopt that similar mentality.
Yeah, I think it comes back to incentives, right? The power of incentives.
Yep.
You have this classic, I don't know if it was a Charlie Munger quote or something, but I mean, show me the incentives and I'll show you the outcome, right? A lot of these, I mean, these
Got it.
CEOs usually owns a lot of shares, so they're skin in the game. So they have all incentives to think like any owner would do. So the shareholder money is their own money, basically. Uh, and I think, if you think about decentralization, right? Obviously, that comes down to, pushing out the responsibility and autonomy to the front force, so to speak, right? But I think it's also like a scaling lever for many of these companies, right? Because if you want to grow big, you have to stay small, right? And decentralization is basically a mechanism to ensure that, right? So you always have that classic quote around, culture doesn't scale, right? I mean, as a company grows, right, you tend to find bureaucracy and cultural issues and all that stuff. But I think decentralization in many ways solve that, right? Because every subsidiary in the company has its own culture, basically, right? So you don't experience many of those hurdles as you grow. But I think also that if it's a common denominator across all our companies, I think there is a higher form of trusteeship. So, I mean, they go beyond what is expected as a management team, right? As a stewards of other people's capital, beyond the legal definition of it, so to speak. So they basically treat, the company's money like theirs own, because it usually is because they own a lot of shares.
And you've mentioned decentralization a lot, and I agree with everything you say. Do you think with these leaders, do you think that decentralization is something that they grew up with at a young age, and when they started to run companies, they knew that this was the best way to go? Or do you think this is something that, when they looked at the data, perhaps at some point they realized that, what, I might have believed a centralized approach was good prior to looking at the data, and once you look at the data and realize the power of decentralization, you change their views. I'm just wondering if you think it's something that was always in their blood and something they always believed in, or if it was something that they kind of learned, and it's kind of a learnable trait. You know what I mean? Because it's not that easy, I can imagine, to put your trust, to take that trust away from yourself and push it into the group. You know what I mean? Like, that certainly takes effort, and that's not that easy to do.
Right. I think it's like, I think first of all, a decentralization across the nine companies in the book, I think it's more like culture at the end of the day. I mean, a lot of companies talk about decentralization and grand business system and so on and so forth, but I think it really comes down to, creating the right culture for entrepreneurship in these type of companies. And I think they just realized, and perhaps learned by trial and error, that in order for these models to work, I mean, if going back to the Swedes, for example, right, and what they truly what they truly realized is that in order for this model to work, you really need to grow in a self-funded manner, right? And you basically need decentralization to scale, because if you don't have decentralization, management would be, you spend all the time on all the post-acquisition work, right?
Yep.
So I think there are, I mean, we point to the three aspects around decentralization in the book, and that goes back to, customer intimacy, because usually these are serving, niche markets. So the folk like you have the best information, and you want the decision where the information is, basically. And secondly, I think it comes back to, as I said, scalability, right? Scalability without bureaucracy. So they basically grow big by staying small. If you think about Fico, for example, right? I mean, it's a $4 billion US turnover business, but it really acts like a, 40 times 100 million business, right? That's really the way to look at it, right? Because it's 40 companies. So, and thirdly, it comes back to the culture. And I think that if you ask Brad Jacobs of the world, right? I think they would probably say that many of these companies are leaving money on the table because they are sacrificing efficiency gains for culture, basically. And the reason, I mean, it basically comes down to that, their ability of reinvestment. I mean, in order to really get compounding thing done, right, you have to really have that sustainability of reinvestment. So, and you really need that strong culture to drive that home. So, I think it really comes down to these three factors around decentralization.
Now, you've got some great stories in the book as well about decentralized culture. I think there was one in there where someone was recently hired and then they had reached out to HQ for some advice. Maybe just walk us through, Kjetil, what, any good stories you can share on on how decentralization kind of works within the within the group that kind of illustrates your point.
Right. Yeah, I think that was we had one story right around in the book, yeah, which is by which was around Hans Nathén at Electrolux, right? And just for context, I mean, he was, as I said, a true pioneer of decentralization in Sweden and inspired many of the companies in the book. And when he took over in the late 1960s, Electrolux was very centralized industrial company, and he basically transformed it into a deeply decentralized group. And during his tenure, I think the company grew something like 80x over 25 years, basically.
Wow.
But the story I think you're referring to was Leif Johansson, who actually later became CEO of Volvo. Was just 28 years old. So he was running Husqvarna's motorcycle division, which Electrolux owned. And at one time, he called headquarters just to ask for advice on some restructuring production issues, right? And the response was basically, I mean, we have fired you with a high salary, make your own decisions.
Oh, I love that story.
So that's like, it really comes down to, that autonomy. And I mean, you have high autonomy, but you also have high accountability, right? So you just need to make your own decisions. And
Well, I think, like you say, and I think the leaders would prefer that. I think the leaders would prefer high accountability and high, and also the high ability to basically make their own decisions as opposed to the reverse, because it's hard to measure too job satisfaction. You put into a decentralized culture, and if you're empowered to make decisions, I think you're going to enjoy your job a lot more than if you're in a culture where you're being told exactly what to do. You know what I mean? You
Right.
can make decisions real time that impact, that create real value, and you're not being beholden to somebody at HQ to tell you what to do. So I'm guessing, again, maybe the guy after that call, he maybe felt bad, but he probably woke up the next morning saying, "Hey, look, if this is how we roll, this is great, because I'm never calling HQ ever again," type of thing, right? And I'm going to go just do my own thing. You know what I mean?
Right. Yeah, no, I think it's, I think a related point perhaps is also that, and something we don't spend that much time in the book, perhaps on that, but there is like this perception that all 9 companies are obviously extremely decentralized, but that they are totally hands off, which is not true, right? I mean, they are handing out a lot of autonomy, but there is a cost to that. I mean, you really feel the pressure to deliver the goods. And if you don't deliver, I mean, you will hear from HQ, right? So I guess it's like
100%.
food within limits, right? You need to deliver.
And again, I think if you're the leaders of those groups, you frankly have it no other way. Because again,
Right.
I think if you like in your book, you have a lot of really good metrics. You talk about cash flow and working capital. And what's clear is that there's a lot of really good metrics on how to measure these companies. But if you're a leader in the group, what better way to be evaluated than based on objective measures? It's not,
Right.
how many conversations you have with the HQ or anything along those lines, and kind of the more softer element. It is based on objective evidence on how well your business is performing, right? It's, again, for the right leadership team, what better way to be evaluated is based on the numbers, which the numbers, again, for the most part, don't lie. Like, especially when you're talking about cash flow. Cash is cash, right?
Right.
You either collected the cash or you didn't. It's either sitting in your bank account or you didn't. And, and maybe just talk a little bit about that, Shell, because again, I think that's another difference with these companies is this real approach, this real focus on cash flow. I think as accountants, we get wrapped up in earnings and EPS and things along those lines. But man, if you're not collecting the cash, your business is going to run into a problem really, really quickly.
Right. I think that, I think it really comes down to, how the model really works, right? Because, cash flow is really the fuel. You can't compound without cash. I mean, if you think about it, there are really, 2 main ingredients at the company that you usually buy, right? And that goes back to predictability. And it goes back to cash conversion, right? Because for this model to work, especially in a self-funded manner, you obviously need cash flows. So everything is rooted around, creating that cash culture and really creating a culture around cash. And that's also why they had this. I mean, I guess we can talk about it later, but they had this something called the rule of 45 among the Swedish companies, which is quite interesting in terms of driving that cash culture home and making sure that every employee in the group can actually impact and understand, what cash flow is and what drives that around the group.
Now, the other key part of your book is that the managers act like owners. And that is then going to drive to how the leaders are compensated. And maybe just talk a little bit about that as well, Kjetil, about how these companies compensate their key leaders and why that is so important that these folks are basically thinking like owners at the end of the day.
Right. Yeah, I think it really goes back to the point around why cash flow is so important with this type of companies. Because if you think about incentives and the compensation mechanism in the companies, they are usually rooted in a cash flow metric, right? So take Lifco, for example. I mean, they don't reward growth alone. They reward profit growth relative to capital employed. So if a subsidiary increases EBITDA by $100, for example, right, the CEO gets a 10% bonus, so $10. But if capital employed also increases by 100 to achieve that growth, 2.50 penalty is deducted, basically. So the bonus drops to 7.50. So basically a 25% return on capital hurdle. But I mean, so everything comes down to cash flow in order for this model to work on a self-funded basis. And I think there was another story in the book we told that we once visited one of the subsidiaries of Lifco, and the CFO told us that Lifco has a very strong policy around receivables. So any receivables over 30 days was written down to zero, right? And you can just imagine, right? If you're the CFO of that company, you will go the extra mile to collect that cash faster, right? So, and then you can, if you multiply that mindset across 250 companies in Lifco, that's how you build a real cash culture, right? So it's these small tweaks and making sure that it's, incentivized that, really deliver this value creation of these companies delivered and just creating a culture around it, which is extremely hard.
The other thing with respect to comp is, this concept of thinking about the long term. If you're an owner of these businesses, you clearly care about the long term success of the business. If you were just, comp was based on salary plus a cash bonus, you're probably not as concerned about the long-term health of the business, because ultimately, if that business didn't work out, you could just leave and probably find another job. But if you were an owner and you have capital invested in the business, if the long-term health of that business is not good, you are going to feel the consequences of that. And maybe just talk a little bit about, about the importance of thinking about the long term. Because again, I also think that that's something else that is, again, it's kind of counter thinking. Is I'm not sure how many folks out there are really, compensated, really thinking about the long term implications and saying, look, what's going to happen in 5 or 6 years. I think it's, again, something that's a little bit unique, and that these compounders have kind of taken to the next level of making sure people think over the long term.
Right. Yeah, I mean, that's an extremely important point, right? And I think it comes down to structure. I think it comes down to incentives, but I also think it comes down to permission to think long term, right? I mean, these managers have the necessary backing from their long-term owners.
Yep.
And it's just like, I mean, when we're visiting these companies, right? Then sometimes we have been fortunate, we have been lucky enough to visit the companies while the management and the long-term owners are present. And it's just interesting and fascinating to, see that in action when you have long-term owners backing their management teams to really think long-term. And so, yeah, I think it comes back to structure, incentives, and permission, actually. And just having that necessary support from the board to also think long term. But I think also another point perhaps is that if you think about these vehicles, I mean, we talked earlier about, my motivation about investing, and I think I focused a lot on single product companies where you had basically the operations role was combined with capital allocation, right? I think it's just a high ask to expect that managers in single product companies should be good operators, but also good capital allocators. But I think in these type of vehicles that we profile in the book, you have basically divided responsibility, right? Because at HQ, you have, long-term management fees, which are fantastic investors. And then you have fantastic operators in the subsidiaries. So I think there is like a built-in mechanism there, which makes it easier actually to fork long-term because you have that structural element there. And you're not constrained to one end market. You have the flexibility. So you have more flexibility in your capital allocation. You don't have to, throw capital after bad capital in one single end market.
Got it. So next, we need to talk a little bit about acquisitive growth and the process of compounding, because again, there's a lot of it's easier said than done to grow by acquisitions. Again, the data would suggest that most acquisitions actually don't end very well. That you'd be better off not doing the acquisition, which again just shows you it's easier said than done. How do these leaders, how do they make it work with these smaller acquisitions? Because the other thing too is I would bet you that a lot of these leaders that sit at HQ, you're going to correct me if I'm wrong, Kjetil, they might be operators first, and the capital element is something that they learn along the way. You know what I mean?
Right.
That this is a learnable trait. It's not necessarily something that these folks came from M&A shops. You know what I mean? Is that this is something that learned along the way. But how are these the guys and gals able to really be so successful, allocating capital into these smaller acquisitions?
Right. I think it's come back to, I mean, if you think about a company like Coca-Cola, for example, right? I mean, obviously they have codified a process around, the R&D efforts that goes into making a great product, right? For example, Coca-Cola.
Yep.
Right. And I think similar, these type of companies have codified their competency and build processes around small private acquisitions. So I think, it's really a long-term process that went into that. And I think that a lot of these companies, they are not, primarily, deal makers in the traditional sense, right? They traditionally look at, making acquisitions and combine that with organic growth, right? So it's more like an industrial heritage, an industrial mindset around acquisitions. And I think that one of the companies we didn't profile in the book called Cycle had a CEO earlier called David Barber. And he had this, this great thing around acquisition that is acquisitions were founded by internally generated funds. It is more akin to organic growth. So, and the mindset around that was more that if you buy similar type of assets, small private assets that are, within adjacency of your own product line, so to speak, and you keep it small and you finance it via internally generated funds, it's actually more like organic growth, right?
Yep.
If you take it a step further, I mean, if you can buy a small private company for, 5 times cash flow, for example, right? 20% return on your day one capital, so to speak, then obviously that is, that is accretive on day one, right? So it's like instant value creation. But if you grow organically, right? I mean, often there's a time element there, right? I mean, finding a new organic leg or finding a new leg, right? So it's kind of funny to think about, acquisition versus organic growth in that context where, in terms of like, being accretive from day one and,
And what's your perspective on, there's a debate between, should the acquisition process kind of be one of the things that HQ was responsible for? Or alternatively, you'd say, look, I want to push that down into the group and let the operators also get in the process of deploying capital. What's your perspective on that, Shell? Do you think that's something that should remain at HQ? Or do you think that's something that, provided the right guardrails, you can push that process directly into the into the groups, this process of deploying capital?
Right. I think it comes back to, how we define. I mean, we usually distinguish between the generalist acquirer and the specialist acquirer, right? And what do I mean by that? I mean, a generalist often have more flexibility, right? They often have more flexibility in terms of the type of targets they buy, so that they often have, a larger total addressable market, so to speak, compared to perhaps a specialist who have the luxury of having a playbook, a deep competency about the underlying end markets, but are perhaps somewhat limited in terms of, the size of that end market. But I think if you really want to scale, at some point, you need to delegate that responsibility down. And I think the reason why I mentioned the generalist and the specialist is that it's not so easy to delegate that responsibility down in an organization if you don't have that, homogenic type of competency about the acquisitions and the underlying markets, right? So it's farther. I mean, the company you represent, Constellation Software, right? I mean, obviously have the luxury of software, right? And software tastes like chicken, as they say. So it's perhaps easier to delegate that responsibility down because, I mean, first of all, the total addressable market for different software companies is so huge, and software is quite homogenic in terms of the competency required, right? So it's easier. So I think there are a lot of nuances that go into that decision. But yeah, I mean, in order to scale and avoid the loss of financial gravity, so to speak, at some point you need to delegate that down, that responsibility, if you have the ability to do so.
Next one I wanted to ask you about is how do these leaders avoid the elephant acquisition? I think I'm sure all of them at some point would get pressure, whether it's from the outside or whatever. They come across, the $1 billion acquisition or whatever the acquisition that, on paper is going to transform the whole business, opportunity to deploy tons of capital. Everything looks good on paper. I'm sure that, that lots of people and the stakeholders on the outside that would be just jumping at the opportunity to go forward. But then these leaders have the ability to really take a step back and say, you know what, it's not the right step for the company. How do they avoid that kind of big mistake, Kjetil? Because I just think the more that they do this, I'm sure all of them have a story where something came up and they just chose to, walk away from it because it wasn't there. But the pressure to close something like that and really, completely change the company is got to be significant. You know what I mean? But they seem to have the ability to not stay within their lane on these smaller acquisitions.
Yeah, I mean, it's an important point, which I think that, most companies, I mean, they start small. It's easier that way. And as they scale, obviously it becomes harder to deploy the majority of that capital into new small acquisitions, right? Because it's like the whale and the plankton problem, right? I mean, eventually you're not satisfied with just a lot of planktons. But I think that it goes back to discipline. It goes back to incentives. I think that, bigger acquisitions usually leads to some type of integration issues, right? So management will spend their entire time integrating that big acquisition. And I think also, obviously, as you go up in size, you typically need to pay a higher price, right? So that goes into the whole understanding the model equation in terms of like, you can't pay up for these acquisitions if you want to grow in a self-funded manner. So, and I also think that, I mean, some of these companies do bigger platform acquisitions, and then they do a lot of small bolt-on acquisitions tied to that platform. So it's not like it's always small acquisitions also, but I think it comes, I mean, just consistently avoiding doing a lot of big acquisition comes back to having that discipline and having the right incentives and just having that focus on return on capital and understanding how the model works, basically.
Yeah. Yeah. No, it's well said. I completely agree. Now the next one, and this is going to lead to my favorite story in the whole book, Kjetil, is succession planning. Now you've quoted a few leaders that go back to the 1960s and the 1970s, which would imply that those companies have been able to withstand their founders leaving the business or stepping away from the business or whatever it may be. Which again is easier said than done. Businesses going through succession planning it's an incredibly difficult process. And again, it's obviously high priority, especially when you have, let's say a founder of that business. But what seems to make these compounders unique is that they do have the ability to get through succession planning. So give us your 2 cents, Kjetil, on the importance of succession planning and why it's a big issue. And obviously, like, how are these compounders able to get through it?
Right. I think, I mean, a common thread among the 9 companies in the book is that they have extremely long, the management teams have extremely long tenures. For example, Amatec, which we profile in the book, I think they've only had like 6 different CEOs during the long tenure. And I think it comes
Wow.
back to this tendency to recruit people internally. So you seldom see a lot of external recruits in this type of companies, right? I mean, I think it comes back to the culture element and thriving within a high-performing decentralized organization that, people, I mean, if you give people a lot of autonomy, they really like to stay there as well, and they'll stay for a long time.
Yep.
Right?
Yep.
So I think that is extremely important element of it. And I think that we talked about, there's a story in the book on Lifco, right? And a colleague of me, by the way, sorry, were you referring to that story about Friday Council, by the way? Sorry.
The story that I was referring to, which, Kjetil, I have now shared with multiple people, is the one where, I don't know if I'm not sure who the group was. It sounds like there was a few of you where you were going up in the elevator.
Right.
And something flashes on your phone that says the CEO that you were about to meet with, there's been a change and he's no longer the CEO. And I've now shared this story with multiple people in my universe. And it is by far my best. I love this story in the book. I think it just illustrates the power of decentralization, but I don't want to tell it, Shadow. You tell us this story this book is loaded with great stories. But this one for me, Shadow, was my absolute favorite. But take us through. I don't know if you were part of that group that went up the elevator that day, or you were the one who checked their phone and got the notice.
Right.
That there's been a bit of a change in leadership. But take us through this. Take us through this story.
Yeah, that was actually my colleague who was in the meeting, not me. But that's a funny story, right? I mean, so this was back in 2019. And my colleague had a 9 a.m. meeting with Fredrik Karlsson, the longtime CEO of Lifco. And just for context, I mean, Fredrik Karlsson had run Lifco for over 21 years. And during that time, he earned his compounded at 25% annually and profits increased really 100x. So it's been an amazing story, right? And so the colleague was up the elevator. And as he was in the elevator, a press release came out, which read that Carlson had just been terminated by the board after a disagreement over his bonus. So what happened was that, I mean, the stock dropped 10% immediately, right? Not exactly a normal morning. And they sit down and Carlson reads the announcement and is calm and no visible frustration. And then he just picks up the phone and calls his broker and says, buy Lifco shares, right? And it was a huge amount of Lifco shares as well. So I guess it just shows you that, I mean, these kind of companies, right? I mean, it's more than one individual person. It's more like you're buying the culture, you're buying the system value of these companies. So it really speaks to the system value of these.
So your colleague goes up the elevator,
right,
and meets with the CEO who has just been fired maybe 10 minutes ago,
right.
And they find out that the share price has gone down by whatever it is, 5 or 10%.
10%. Yeah.
And the CEO at that point calls his broker right in the middle of the meeting and says, buy a whole bunch of shares of the company, which I'm not sure how many people on the planet would actually do that in
Right.
that situation. The fact that that guy actually did that is shocking. But tell us exactly, Kjetil, why he did that. Because again, you would have thought some people would say, forget this, I'm selling out. But this guy's just been fired. The share price has now dropped by 10%. And you might be thinking the guy's sitting there saying, hey, man, I hope it drops more. But he's taken a different view and saying, you know what, I'm going to go out and buy shares due to this drop. Take us through why he actually made that decision to buy.
Yeah, and the funny thing here, I think he actually owns these shares still, right? He's known in Verco as the founder and CEO of Verco, where it's a sort of similar type of vehicle. But it goes back to culture, it goes back to system value, and it goes back to trust in. I mean, Per Vandermarsson, who is now the CEO of Lifco, right? I mean, he was the CFO of Lifco when Paddy Carlson was CEO, and it just goes back to these successions that you have built a legacy, you have built a system, you have built a culture, and you just have this faith in the compounding trajectory of that business because you trust the people there, right? So it just speaks a long way about culture, I think, which is extremely hard to build.
Yeah. Oh, I just think that's the perfect story that really illustrates, the greatness of these compounders, right? That are featured in your book, that the CEO can get fired and then he's out there buying shares because he has so much trust in the people that he trained and that he's passing the torch to, right? It's just such a great story that illustrates just so many cool things about decentralization and these compounders.
Right.
Now, if we look forward, Kjetil, now everyone's probably thinking, well, how do we find the next compounder? Because again, a lot of these companies, their multiples get high and they get pricey. And a lot of the benefit would come if you're able to find the next one, which I'm sure is basically a huge chunk of what you do on a daily basis. But how do you go about what are some of the things that people should look for when trying to find the next compounder?
Right. I think yeah, that's a hard question, right? And I think it's like a paradox, because often you want to find these compounders early, so you get the benefit of a small base and the growth of that small base. But you also want to find these, high performance cultures that we talked about, and the track record, right? It's the same as how you want to choose the asset manager for that sake, right? So you want to look at the track record, and it's hard to find a long track record in these smaller companies, right? So and sometimes you get the luxury of a small base where a company have a management team with a track record, or in other type of companies where they have done similar stuff. So, but I think it really goes about assessing the management and assessing, do they really get it? It's really easy to copy the deal aspect, but it's really hard to copy the culture. I mean, just look at, for example, if you look at Berkshire, right? I mean, there's been a lot of copycats, but no one has been the next Berkshire, right? Yeah. So it's similar, but yeah, it really comes back to those ingredients, I think, and it's not easy. It's not easy. It look from outside, right? It looks really easy, but if you look at what's happening in the inside and all the trial and errors, all the experience, it's really hard. So we have a deep respect for how hard it is actually, and yeah, I think there's like the OGs of Sweden, for example, some of these which are from in the book, right? Disco Attack, Indutrade, etc. I mean, it's really a special class of compounder. I mean, it's really, really hard to execute at that level. And there's so much stuff happening behind the scenes that we have just got more and more respect for as we wrote the book actually.
Yeah, and is there any, when you look at the compounders, one of the things that sticks out is that yeah, obviously a lot of them are based in Sweden.
Right.
But in terms of industry, they're different. You know what I mean? It's not like it's one specific industry. But when you look at trying to find the next compounder, do you think there's anything to be said for geography, or do you think there's anything to be said for industry, or does it really boil down to like you're saying, Kjetil, the management team and their approach and how they go about it? And I guess again, is there any geographies or industries that
Right.
are maybe higher likelihood that they would have a compounder that would end up in your book one day or the next version of your book?
Right. I think perhaps it's less about the industry and more about the structure of the industry, right?
Yeah.
I think it really comes down to two things. I think first of all, predictability. And I think that touches on a lot of the underlying drivers. I mean, you want that recurring revenue. You want to be perhaps more exposed to the operating expenditures than the capex, for example. I think you want to have differentiated products, not commodity products, which gives you some margins, pricing power. So it's simply spec'd in products, typically embedded, which means lower churn. So it's not these, one-off projects, right? You want that recurringness. So it's often industrial parts, components, consumable, pro products, right?
Yep.
We have a company in the book, IndyTrade, and they often say that they don't want products that are bigger than a horse. Which is just another way of saying, speaking of capital intensity, right? You need cash conversion basically, right? So,
Hmm.
because back to the discussion we had earlier, I mean, the profits need to be converted into cash for this model to really work. So that's why you want to have capitalized businesses, you want high margins, you want strong conversion, because you want to grow without printing another shares and stretching the balance sheet. And I think, I guess we didn't talk about that, but across all the 9 companies, they have basically delivered the returns that we talked about in the introduction without printing a single share, which is quite unusual, right?
Yeah.
And it just
It's
speaks
amazing.
to that, self-funded discipline.
Absolutely. That's a great point. Like again, you talk about the ability to stay in your lane and not overextend yourself
Right.
on debt and things like that. Like it just takes a special person to be able to have that level of discipline to stay in your lane and not be seduced by, the large acquisition that again on paper looks great, but if it doesn't go, if a couple things don't go sideways or if a couple things go sideways, you can put the whole business at risk. You know what I
Right.
mean?
Yeah, exactly.
Um, how much time do you spend, looking at some of these new, the new technologies? Obviously, you can't pick up the newspaper without reading about artificial intelligence. AI is, we've got a lot of, companies they're focusing on AI, robotics and a whole bunch of different technologies. And I'm just wondering from your perspective, how much time you spend looking at these type of businesses and whether you think, the compounding model could fall into could fall into this area where it's again new technologies, newer companies. Does the compounding model work as well with those? And again, how much time do you spend looking at those different industries?
Right. Well, I think that, I mean, there will certainly pop up opportunities there as well, I think, at one point. But I think it really comes down to, it comes down to what we talked about earlier. I think in terms of it's not so much focus on the industry itself, more about the structure, right? So, I mean, one thing that we didn't talk about is a lot of these companies usually target extremely small markets, right? And, AI
Yep.
is obviously a fantastic growth market and it's a lot of competition, a lot of players, a lot of attention, right? But I think what's special about these companies is that they actually prefer quite small markets. And the reason obviously is that they small markets don't usually allow that many competitors in the first place, right? They can't absorb that much capital, which means that you have a favorable favorable climate in terms of competition. So fewer competitors means you have usually some pricing power, which obviously is something that you want to have. So yeah, I think it really comes back to the structure of the industry, not so much about the spurs industry itself, and just staying disciplined. I mean, we had an example in book actually from Endotech. I mean, they target markets of 200 to 300 million in size, right? and they often aims to be, a 25 to 30% market share. So often number one or number two position. And so when you collect, a lot of these small markets at scale becomes very interesting because obviously all the cash flow gets reinvested at the HQ level, right?
Now, what about high organic growth businesses? I think if you look at a lot of these startups or newer businesses within AI, they would certainly be banking on very, very high organic growth. And I'm just wondering, when you look at the companies you profile, do you think do you think the compounding model can work as well with a high organic growth business? Do you think it works in the same fashion, or do you think it's more of a challenge for these high organic growth businesses to maybe apply that same framework?
Right. I mean, obviously you want high organic growth, but I mean, if you're looking at companies that screen very well on organic growth, that often comes with a price, right? So
Yep.
that usually
Yep.
hurts your incremental returns on capital, and then we're back to how the model really works and how it works in the long term, right? So I think that is like a price question, really. But I mean, you obviously want the best of both worlds. You want to pay a low price, and you want high organic growth. So um, yeah,
Yeah, and I think the other thing with some of these newer entrants as well is, again, we talked about cash flow.
right,
Embedding with a lot of these startups, there's going to be a big cash burn
right,
at the outset, and I think with a lot of the compounders, they rely on positive cash flow, not
right.
negative cash flow. If you have a business that's generating negative cash flow, even if it's due to R&D or whatever it might be, probably not going to rank too high on the on the leaderboard. You know what I
Right.
mean?
Right. Yeah, and you need cash flow for this model to work. So yeah, it comes back to the structure, and so not focusing so much on the industry, but more on the structure of the industry. So small markets where you have more, more, a better climate actually to generate that cash flow because you have some more pricing power. You don't have that competitive position, which usually leads to lower margins and lower cash flow, right?
Now, there's probably some people out there saying as well, I'm just going to take this book and I'm going to create a business that's going to do exactly that follow the framework exactly this book. And you said, Shadow, something very interesting, that as you spend more time with these companies and get further inside of them, you realize, how difficult it actually is to do to do what they're doing. Do you have any good examples of ones where people have just tried to do a copycat and it doesn't end well? Like, why do you think it is easier said than done to apply to apply the framework?
Right. Yeah, no, I think it goes back to, having a deep respect for how the modeling works, right? Cash culture, pacing, not overpaying. I think it looks easy from outside. It's easy to do a lot of deals and tell the world that you are, decentralized, but extremely hard to copy the culture among the best ones, right? And I think it's like, for example, I mean, you're buying a company, right? What do you do plus the earn-out period, right? Where you perhaps need to replace the management team, right? And let's say you have
Hmm.
both are highly technical company, which means that you're relying on the people that you bought in the company. How are you prepared for that, right? And if you multiply that type of problem and issue with, if you multiply by 100, you get a lot of issues you have to eventually solve, right? But I think
Yep.
there's just this like there's so much happening on the inside. It's hard to appreciate, and some of the best ones that we profile in the book, they just make it look too easy, I think, which obviously inspire a lot of companies. And I think it's just this division between, perhaps more of these industrial rooted type of acquirers compared to more of these financially driven, financial engineering type companies, right? Where they copy the deal aspect, but they don't manage to copy the culture, and they don't
Yep.
have they basically don't have the time to develop that culture either, right? Because they just go out to buy a lot of companies, and then yeah, it looks great on paper for perhaps a couple of years, and then stuff happens, right? Reality hits.
Yeah. Well, and the other thing too, is the diligence that should be done. Like we talked a little bit about the process of deploying capital. there is, a lot to be learned. There is a repeatable process there, but if proper diligence isn't done on these companies that you're looking to acquire, it can end very, 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 very badly.
Right. And I think that speaks, I guess, also to, you know, if you think about some of the Swedish companies that we profile in the book, they usually have more of a preferred buyer type of advantage because they are, usually they operate within adjacency, within the same market. So they basically speak pretty much the same language as the seller of the business. And they usually have a playbook because they have bought so many similar type of companies, which means that compared to perhaps a copycat who's relying perhaps 100% on brokers and has more of a generalist approach, these companies in the book have, really an advantage in many of these negotiations where they can get these companies at attractive prices.
Yeah. Well, and the other thing I think that's evident as well is, there's a lot of copycats out there that are just, you're going to buy, but then they're going to sell at some point in the future. And I think
Right.
with a lot of the companies featured in your book, it's buy
Buy and hold,
and
right?
it's hold forever.
Yeah.
You buy and hold. Like it's there is no plan to sell it. And I think if you're planning just coming in to flip them, that also is not really part of the playbook per se. Like I'm sure there's a little bit, I think there's a few examples
Right.
where they've decided to make certain sales
Right.
and this and that. But again, by and large, you're buying these small companies. You're not planning on flipping them in 5 years or
Yeah,
7 years or whatever the typical
and the
fund.
word gets out, right? I mean, these sellers are not stupid. So
Absolutely.
I mean, if you
Yeah.
have a long track record of doing acquisitions the right way, then the word gets out, and news tellers hear about it, and
100%.
you get a co-con of it.
100%. 100% right. I totally agree with you, Shadow. And now as we wrap, let's just talk a little bit about the book,
Right.
a little bit more directly about the book in terms of, the reception that it's got. I don't think there's many books out there that, that are quite like this. So I think it's unique and it's a must read for everybody. Especially if you're interested in investing, but maybe just give us some perspective on how the book has been received and maybe just some common questions you typically get when you're out talking about the book.
Yeah. I mean, yeah, we have been super encouraged actually by the response. So it reached much further than we ever expected, and we got strong feedback from management teams of the companies in the book, obviously, and the boards of those companies. And there's a lot of investors reaching out almost on a weekly basis, which are launching their own vehicles. I mean, back to your question around copycats, but there's a lot of people launching their own vehicles, and they're reaching out to us, and they want to hear what we have to say, which is getting that discussion is super interesting. And there's actually been a lot of interest from, the Ivy League schools in North America, actually, where they want to use parts of the book in their classes. So basically licensing parts of the books to use in the class, which is really interesting. And actually right now we have a Korean translation coming out, which is interesting. And
Wow.
yeah, that's pretty
Wow.
exciting. And the audiobook is actually launching as well. So yeah, I mean, overall it's been expectations, far been reached. And yeah, so that's been, and in terms of questions, I mean, I guess most of the questions are centered around the Swedish companies in the book. And yeah, they're just surprised by the playbook, the performance, the culture, the decentralized model, and all those aspects. So yeah, we've been super impressed by the response so far. So yeah.
That's awesome. Now the Ivy schools, do you think it's a function of, their current material is warning everybody don't do acquisitions, and then they
Right.
pick up your book and say, well, actually, if you do acquisitions right, it actually can be quite good, and therefore we should maybe incorporate some
Right.
viewpoints from the other end of the spectrum. Do you think that's what it is?
I actually think so. I mean, back to your question around, the 70% statistic, right? I think that they just realize and they're just curious about the fact that there's actually more to that statistic, right?
Yeah.
So they just want to, educate themselves basically. And that's interesting. We are welcoming that.
No, that's great. And will there be Will there be a next version of the book, Kjetil? Like where you have maybe another list of compounders that maybe have come to your attention as a result of the book, where you guys would then put in, you know, an updated version featuring maybe a few new companies? Is that part of the the process as well, or is this a one and done deal for you guys?
It's not part of the plan or anything, but I mean, who knows? But I think we realized how much time it actually took to write this book, and you know, we are fund managers at the end of the day, right? So we need to focus on our funds and call money that way, right? We have two investment funds to run. So I think not in the near time. So but I mean, it's been an extremely interesting project, and since we own many of these companies in the funds, it's just a good way to dive even deeper, right? And so it's been beneficial in that way as well.
Yeah, I presumably the IRR on the book is maybe not is not the same as what you know what the actual compounders can get themselves by operating the business. So I can imagine the blood, sweat, and tears necessary to put the book together is a ton of effort.
Yeah.
Well,
Absolutely.
Kjetil, thank you very much for taking the time. This has been great. Again, the book, for the you know, umpteenth time, the book is called The Compounders: From Small Acquisitions to Giant Shareholder Returns. I would highly encourage people to take a read of it. It's a terrific book. Tons of great stories and things like that in there. Right on the cover of the book is an endorsement by Will Thorndike, who also wrote The Outsiders, and that's another a really good book as well.
Absolutely.
But there's a lot of comparables between Kjetil, between your book and The Outsiders. But again, if you know, whether you're a value investor or not, I would highly encourage you to everyone to take a read. And Kjetil, thank you very much for taking the time. We really appreciate it.
Yeah, thank you for having me, actually. And just to emphasize, we are three authors of this book. I mean, I think you said your book, but we are three authors of this book. But that's important to highlight also.
Yep. No, absolutely.
My two colleagues.
Well, thanks, Kjetil. Yeah, thanks, Kjetil. And we'll chat soon. But thank you.
Thank you. Thank you so much. Bye-bye.